Hey everybody, welcome to the morning market briefing. It's Wednesday, June 15th, 2022. Hope you guys are doing well. Big day, big day. Excited to be here. Futures are up, so that's something to be excited about. Hopefully that holds, although I think there's a fair amount of skepticism among those sitting at the table. Dow futures up 58 basis points, S&P futures up 70 basis points, NASDAQ futures up 84 basis points. Gold rallying a little bit, silver rallying a little bit, oil down, but not necessarily to a noteworthy extent. We do have a couple programming notes before we jump into the content. First things first, and most importantly, Tom Russell may or may not be joining us remotely. Tom is speaking at a conference up in Philadelphia, so he was going to get up and run the Rocky Steps. No word yet on if that has happened.
I'm here. Can you hear
But
me?
talking bond land, so should be pretty good content. We'll try to get a recap from him on that. We do have a podcast that we recorded yesterday. It's up on our podcast feed, whether you listen to podcasts on Apple, Spotify, whatever it may be. We will have an email blast that goes out with all those links, but you can also just search Narwhal Capital and find that episode. We talk a lot about the inflation situation, the rate hikes, the potential for recession, unemployment risks, all of those kind of happy topics. So it's a pretty lengthy discussion between myself and Logan Johnson. I will say, if you're a regular listener to this call, it may seem relatively fundamental or possibly repetitive to things we talk on here. We're trying to get some other people up to the speed that don't hop on the morning call. So we have that. And also, lastly, Friday. This is important, I think, for people on the call. On Friday, we're going to do a slightly different type of episode of the morning market briefing. We're going to do an episode in which we answer questions from clients, ideally from listeners to this show. We'll try to take some on the fly, but in order to kind of build a show that still makes some degree of sense and flows well, it would be really, really helpful if you would email me questions you would like to have answered. It can be really on anything that's going on right now, our views on certain things, whatever. Shoot us an email. My email is ahall@narwhalcapital.com. So my first initial, my last name at narwhalcapital.com. Just shoot us questions that you want answered on air Friday. So Friday's call is just going to be Q&A. There may be some things that just make more sense to do a one-off email response. If it's something specific to your portfolio, you may see a response like that. But we're going to try to take, honestly, as many questions as we can get would be great. This is our first time doing something like this on the morning call. So please send me questions, ahall@narwhalcapital.com, so that we can kind of work through them. With that out of the way, let's jump in a little bit and talk about what we're looking at today. We do have economic data that came in yesterday. PPI was broadly in line, but the headline number was still 10.8% and 8.3% ex food and energy. Ben, any major takeaways from the data we got yesterday early in the morning?
No huge takeaways from yesterday. I think that basically it's kind of what we were expecting. The CPI was a big mover, and that'll be what we're watching going forward. We did get retail sales in this morning. Retail sales definitely disappointed. We went down 0.3% on a month-over-month basis. If you exclude autos, you're up 5.5%, and if you exclude autos and gas, you're up 0.1%. All big deceleration. So the headline going down to and under the estimates. So the headline, you went to negative 0.3% from plus 0.9. To X autos, you went from plus 0.6 to plus 0.5. And the X autos and gas, you went from plus 1.0 to plus 0.1. Biggest declines are, and on the sequential is going to be your autos, which went down from negative 1.9% in April to negative 3.7%. So big declines there. Electronics continue to be terrible. We did get some news yesterday too. It's not just Apple that's kind of slowing down production. It's also Samsung. Samsung is trying to get out of some contracts on its Galaxy phones as well. So those electronic sales were down 4.5%. They were down 4.2% in April. So that continues to be a weak spot. We know about PCs, of course, as well. Intel came out last week saying that things are going to be worse than expected. Everything is pretty much worse than expected for Intel. And online, you're still up 7% on a year-over-year basis, but that's slower than up 9.2% last month. And I would say on the 7%, you got to factor in inflation on that. And if you're factoring in an 8.5% inflation, you're obviously declining in real dollar terms. So retail sales not so good today. I think a lot of people kind of expected that. We know the estimates, but even the estimates are a little bit stale at this point. So a weak retail sales number continues to set the stage for a weak GDP number when we get that for Q2. And I think that this just kind of further cements the odds of a recession right now, not in 2023, like a lot of people are saying. But I think that we're in one right now.
Ben, I want to give you a statement and just see if you agree. When we're thinking about things, I think retail sales is a great example. When we're looking at broad economic data and expectations for that, but we're seeing individual company announcements coming through that maybe aren't aligned with the broader economic expectation. How much of an impact does the actual economic data at a high level, retail sales number, carry relative to Target saying, hey, we're cutting guidance?
I think the companies, what we see from the companies leads what we actually see in the underlying economic data. But you got to be careful with that, because sometimes you get these head fakes. So the number of times you'll see some website coming out saying, it's the end of the world, look at this company, they just took down guidance, Bed Bath & Beyond lowered its guidance, and then extrapolate that across to other economic data. There's a danger in that. But I would say the economic data, if there is something bad happening, the economic data will reflect that after the company says that. So what we want to be, that's why we read these conference calls. That's why we look at this and do this analysis from the bottom up as well, because we want to understand what's actually going on before it happens, with the caveat that sometimes that we could be faked out.
And I think that's I think a lot of people, I've been on the phone a lot with clients this week. I think a lot of people are looking for not even necessarily a reason for optimism, but a reason to think, hey, maybe this isn't going to be continuously awful. There's light at the end of the tunnel, maybe. And we touched on this a little bit in the podcast I did yesterday with Logan. I mean, I think the reason that you should have some hope for this is I do think the market is pricing in a lot of the economic downside much faster than we're getting the data. I don't know if you would agree with that sentiment. I'm not suggesting that the economic data is about to improve, but I do think the market has had a pretty pronounced history lately as technology has enabled faster decision-making, access to more data, that kind of thing. I think people have gotten smarter as investors. And one thing that can happen there is, kind of to your point, potentially an overcorrection to the upside or the downside in market trading. But the trend, I feel like, is often quicker than the actual data.
Yeah, I would agree with that. I think that's a very good generalization. I'm not sure what that means in this case.
Yeah,
the application in this case. But I wouldn't disagree with that.
Layoffs, I think, is another kind of example like this. I mean, we're still, in some regards, looking for a major employment figure that really changes the narrative. We've talked about how even as recently as last week, Janet Yellen was out touting how good employment was. And yet we're getting company after company announcing layoffs. Redfin laying off 900. Discovery is laying off 1,000 specifically in its U.S. advertising sales team, trying to reduce the global sales force by as much as 30%. We've got a Stellantis plant that's just kind of going to have these indefinite layoffs. They employ about 2,200 people. Starting June 20th, they're going to work from the bottom up and start letting people go. Ben, this is a trend that we were seeing that's quite pronounced happening. It seems like every day. I feel like we joked about this yesterday, but I mean, I feel like if you just added up the public announcements of workforce reductions that we've seen, we're looking at a pretty large number of newly unemployed people.
Yeah, and I mean, you can start by looking at, this is a one-off, that's a one-off. I mean, Redfin stock has fallen from $97 to $8. So when they say May demand was 17% below expectations, and basically just throwing the kitchen sink out, saying we could be facing years, not months, of fewer home sales, you might just say, oh, that's a Redfin deal. But when you start to compound these downgrades and layoffs on top of one another across industries, it becomes a little bit more systematic of what's actually going in the underlying economy. But again, dramatic language. May demand 17% below expectations in terms of home sales. They just don't have enough work. for the staff that they have. And they said that we could be facing years, not months, of fewer home sales, really driven by higher mortgage rates, which is actually interesting. We actually did get a little bit of positive news on mortgage applications this morning, but that's a very noisy number. That's just as an aside. Discovery, they were just spun off and merged. So you might see some redundancies in that department. But again, 30% of the sales team getting laid off, that's a big number. And when you couple that with what we're seeing at Redfin, and then what we're seeing at Stellantis owns Chrysler. They have a plant in Stamping, Michigan, and employs 2,200 people. And they said that they're laying off people from the bottom up, which is
what a morale booster.
If you're the low man on the totem pole, get ready because you're about to be gone.
It's going to be tough for Hicks when we start doing that.
You could say that this is part of the supply chain, but you don't generally want to lay off and shut in production when you have a supply issue. And importantly, when you have an indefinite layoff, that means that you're not anticipating a resumption in production anytime soon. So those three news items yesterday and into today are interesting. I would expect to see those reflected in more of the national employment data over the next number of weeks.
Biden sent a letter to energy companies, specifically those in the refining space: Marathon Petroleum, Valero, Phillips 66, Chevron, BP, Exxon, Shell. Couple quotes, kind of stand out. First, at a time of war, refinery profit margins well above normal being passed directly onto American families are not acceptable. I don't think anybody would be real surprised by that quote. The second quote that we have kind of in the notes, they're the one that really kind of got me going. If you watch Family Guys, it started really grinding my gears. The lack of refining capacity and resulting unprecedented refinery profit margins are blunting the impact of the historic actions my administration has taken to address Vladimir Putin's price hike and are driving up costs for consumers. I mean, he's just sad that his ideas aren't working, right? I mean, it's wild.
Yeah, I agree. He's asking the companies to go to the energy department and say why they have cut capacity. We know why why capacity is lower, and it is about 5% lower than it was before the pandemic. But there are two reasons for that. One is there are aging facilities that were permanently closed, and that were probably going to be closed anyway. And the second reason is that other refineries are being modified. Why are they being modified? To have a new renewable diesel rather than petroleum-based fuels. And that is in direct response to federal policies incentivizing green production. So, this is,
you can't tell people to stop doing so much of what they're doing and then be upset that they can't do more.
Right.
It reminds me, for a while, I've got a 7-year-old daughter. We had to start really supervising bath and shower time, because you'd go in and you'd have a brand new bottle of children's body wash and shampoo, and the next day half of it would be gone. It's just draining. Well, I can't take away the soap and then be like, why aren't you clean?
Yeah.
like, let's have some reasonable steps here. It's wild. I mean, I think it's misguided. I'm very concerned about the administration's preparations to take, quote, any reasonable step that would help companies increase output. I think that's so inconsistent with their policy that I think what they actually mean is we're going to just layer on taxes, penalties, fines to try to just force behavior that we want, not just in the short term, but in the long term.
Yeah, I mean, it's kind of negotiations one-on-one, but it has to be credible. And on one side, you're saying you're trying to do very overtly carrot and stick, good cop, bad cop, within the same letter. The problem is the bad cop is supported by other rhetoric. The good cop seems like I better say this. So that's what I would say to
that. Central banks, it's just chaos. Ben, explain kind of what's going on with the Bank of Japan and how people are kind of positioning portfolios around that, because they're at a real risk of breaking.
Yeah, this started in earnest earlier this week, and I didn't really want to bring it up on the morning market briefing because there's just a lot of context that is required for it. But essentially, it's becoming a bigger issue now. So I thought it was important to bring up what the Bank of Japan is doing. So the Bank of Japan operates like the Federal Reserve. They have control over the money supply in the country. And what they've been doing is that they have been buying bonds. And unlike the Federal Reserve, they haven't embarked on a quantitative tightening program. They're still actively buying the Japanese government bonds, or JGBs. Right now, they have a cap of 25 basis points on JGBs, but futures are now trading at 60 basis points, which means that foreign investors are essentially betting that the Bank of Japan is not going to be able to keep the interest rate anchored at 25 basis points. In order to offset this, the Bank of Japan continues to buy more and more JGBs, because if you buy more bonds, you suppress the interest rate. And that's what they're trying to do. But the delta, the difference between what the Bank of Japan is buying for them and what the futures are trading for, is widening such to an extent that the Bank of Japan is going to have to do more and more and more. For context, they bought 2.2 trillion yen of JGBs on Tuesday alone. That sounds like a huge number. It is. It's 15 billion US dollars. It's basically triple what the US was doing in its quantitative easing program at the peak. The reason the Bank of Japan needs to keep interest rates low is because they have a massive debt to GDP ratio. You think our debt to GDP ratio is high at 120%? Theirs is 250%. So they literally can't afford higher interest rates. You got a bunch of hedge funds now piling into this trade. And what's happening is you're in this cycle where Japan doesn't produce any of its own commodities, especially on the energy side. So they're having to import it, but they're having to import more expensive commodities, which means that they are structurally short the yen, which puts downward pressure on the yen. No one wants yen. And on top of that, they're having to come in and keep interest rates down. So you have this perverse reaction where there's more inflation, there's more pressure for interest rates to go up, and yet the Bank of Japan has to do even more in those scenarios to support the currency, which is even more negative for inflation. So, you're just creating this pent up potential energy. It's like going up a roller coaster, and banks can break. And I'm not saying we're breaking right now, but I'm saying that it needs to be watched very carefully. There is a risk that it does. It's happened before. It happened at the Bank of England in the 90s. It happened when Switzerland devalued their currency in 2016. And so we're watching that very carefully, I guess is what I'd say.
ECB holding an emergency meeting this morning. Italian bonds selling off dramatically. I mean, the timing of this could not be worse given the fact that they just kind of wrapped up a meeting. What's changed in the last, couple of days, couple of weeks?
Yeah, I mean, it's been a week since the last ECB meeting, and they called it an ad hoc meeting. Basically what happened was interest rates just started to explode, especially for Italian bonds. I don't think they actually exploded as much, certainly not what we saw in 2011 when Greece was circling the drain. But they did say changes in financing conditions that go beyond fundamental factors and that threaten monetary policy transmission will not be tolerated. They say the commitment to stave off fragmentation, quote, has no limit. So they met for a couple hours this morning. They issued a very brief statement, basically saying that they might restart bond purchases in order to make sure that some of these countries don't have credit risk, like Italy, like Greece, those countries that we talked about in 2011 that are now coming back to the fore. So again, central banks are starting to get scared, especially with the market reactions on some of these things.
Meanwhile, we will hear from our central bank, the Fed, today. Jeff Gundlach, who's, I guess, he's arguably the most famous bond portfolio manager in the U.S., if such a thing exists. Nobody likes bond guys. Shout out to Tom. Gundlach is really kind of positioning himself as a watered down, weaker, cooler headed Tom Russell. Says he wants a rate hike up to 3%, a 200 basis point move. Tom says, hey, let's just go ahead and take this thing to 6 or 7, do what we got to do, get it over with. But Gundlach calling for a higher rate. We've seen a couple folks on Twitter looking for the, a full 1 point move on this, but the consensus is at 75 basis points. It's moved there relatively quickly, as we discussed yesterday. Friday, we were still at 50 basis points. The CPI came in, and all of a sudden people started getting a little more serious. Ben, what are you expecting? I mean, I think in a weird way, we talked about this some this morning, the Feds put themselves in a bit of a no-win situation. I think at 50 basis points, if that were still the consensus, there would be people that would view 75 bips favorably as a sign of real strength and real initiative. If the expectation is now 75, I don't know where you go, because I think people would worry about 100. I think people would be furious about 50. 75 is the expectation. So, you did whatever I thought you would, but I don't think there's a real upside to anything they could announce.
The only lever that I think they could pull would be on the projections.
Yeah.
So every 3 months they come out with these economic projections, which take it with a grain of salt, because they had inflation for the year at 4.3%. And we've averaged close to 8% in the first half of the year. So we basically have to average 0 in the second half. So that's just not going to happen. So they're going to have to revise that. Their initial read on GDP for the year was up 4% when they came out with that in December. That's going to have to come down. That might be, I don't know, that might be 0% by the time everything's all washed out. And their estimate on rate increases was 0.9% in December, 1.9% in March, and by the end of this meeting we'll be at 1.75% already. So that's going to have to be revised up. So anyway, the economic projections, take it with a grain of salt, but it is a lens where they can influence policy and determine their hawkishness or dovishness tilt. And I think they could increase their rate hike expectations more. So if we're looking at 3 to 3.5% by the end of the year, maybe that's seen a little bit hawkishly, but that could be a lever that they pull. The big thing they're going to have to worry about is, with Bank of Japan going crazy on the money printing, ECB reversing course, you're going to have massive policy divergence that creates an extremely strong dollar that hurts our manufacturers even more, and also hurts the other countries because they're importing US dollar based oil. So it's just a no-win situation for them. And
they put themselves there.
They put themselves there. The whole world's put itself there, and it's going to be really difficult to get out of that. I don't envy their job.
And that's one of those things. I mean, I think if they adjust their expectations, let's say they take rates to say, hey, we're going to be at 3.5. They're going to have to adjust everything else around that. I mean, that probably means, hey, we're going to say rates are going to be 3.5. GDP is going to be 0.5%. Unemployment is going to be 6%. Inflation's still going to be 5.5. 6.
Yes.
I mean,
it shows the fecklessness of the Fed.
Yeah. You can't move one of these levers without impacting the other, but you got to move it. And you got to make a move there. We're going to wrap it up there. We'll definitely do a full recap of the Fed announcement. I think probably the commentary is much more important than the actual rate, which I think is largely baked in at this point. So the commentary will be very interesting to watch. Again, Friday, Q&A on the morning market briefing. Send questions to ahall@narwhalcapital.com, and we'll talk to you guys tomorrow.